first topic and focus on the rubber industry market review. And in this session, we have our guest, Mr. Jom Jacob, is a rubber industry analyst. He'll be giving a talk on the natural rubber market review. Let me introduce about Mr. Jom Jacob. I mean, he's recognized as independent analyst in global rubber industry. He has more than 30 years experience as a global rubber analyst, as a resource expert in conferences, seminars, and workshops. He has extensive knowledge in analyzing the rubber market, forecasting industry trends, and also formulating long-term policies and development plans for the natural rubber sector. And he is well connected from the professionals in businesses involved in the commodity markets, downstream rubber manufacturing, investment banks, hedge funds across the countries. He also served as the association of natural rubber producing countries, we call it ANRPC, as a senior economist for 11 years. He worked with the Rubber Board of India by holding various positions for 23 years. And the Center for Development Studies in India for 2 years as a researcher. So he had extensive experience. He holds a master's in statistics from the Kerala University in India and MPhil in applied economics from Jawaharlal Nehru University in New Delhi. He is also a certified financial technician of the UK-based Society of Technical Investors. So that's Mr. Jom Jacob. As you see, his extensive experience. We'll be talking about natural rubber market review. Mr. Jom Jacob, please.
Welcome to the NR market review. In the last episode of the NR market review held last Monday, we made 4 key observations. Number 1, we observed that, or we expected that, rubber futures would be weighed down by geopolitics between Russia and West allies on Ukraine. Number 2, we expected that physical price would gain further, driven by seasonal low supply and improving demand outlook. Improving demand outlook because several countries are reopening international borders. That was the point behind the demand outlook, improving demand outlook. Third observations we made was that rubber futures would rubber futures and physical markets would be following divergent trends. Means futures may be going down and physical may be going down. That means the two will be following divergent trends. Fourth observations which we made was that latex market will exhibit greater momentum relative to technically specified rubber or TSR. So let us review what happened last week. Last week was eventful because on last Thursday, that means or 24th of February, Russia invaded Ukraine, setting the beginning of a war. The Western allies retaliated by imposing sanctions against Russia. Russia is world's second largest crude oil producer and gas supplier, especially to Europe. Russia's invasion of Ukraine sends oil prices above $100 a barrel for the first time since 2014. On last Thursday, with the global benchmark which is called Brent crude oil touching around $105 or $105 per barrel. However, oil prices cooled off and Brent crude oil prices came down to $98 in the subsequent 2 days. In the context of the Ukraine war and the sanctions imposed on Russia, let us examine the significance of Russia in the global rubber industry. How significant is Russia in the global rubber industry? Russia is a major producer and exporter of synthetic rubber. I repeat, producer and exporter of synthetic rubber. Annually, Russia produces 1.6 million tons of synthetic rubber, and it comes to 11% of the global production of synthetic rubber. Russia exports 1.0 million tons of synthetic rubber per year, and this comes to nearly 11% of the total global exports of synthetic rubber. Russia annually consumes 0.7 million tons of synthetic rubber, and this comes to nearly 5% of the total global consumption of synthetic rubber. But Russia consumes very little natural rubber. Annual consumption of natural rubber is only 115,000 tons only. And this is only less than 1% of the total global consumption of natural rubber. That means Russia is an insignificant player in terms of consumption of natural rubber, but not so in the case of production, export, or consumption of synthetic rubber. Moreover, synthetic rubber constitutes 85% of the total consumption of NR plus SR, or total rubber, in Russia. In the total of NR plus SR consumed in Russia, synthetic rubber constitutes 85%. That means NR share comes to 15% only. Obviously, the sanctions imposed on Russia is likely to impact on SR sector. SR, I mean synthetic rubber sector, rather than NR, natural rubber. The sanctions imposed on Russia can disrupt the supply of SR from Russia. We have to consider that Russia is accounting 11% of the global production of synthetic rubber. So the sanctions imposed on Russia can disrupt the supply of SR from Russia. This, together with the soaring oil prices, can make synthetic rubber more expensive. A more expensive synthetic rubber can be an advantage for NR. It can be, but we have to consider the various other aspects also. We will continue on what happens with reference to the Ukraine war. On Saturday, that is February 26, the West allies announced the sweeping new sanctions, including blocking some of the banks from the SWIFT international payment system. SWIFT stands for SWIFT, stands for Society for Worldwide Interbank Financial Telecommunications. According to sources in the EU, some 70% of the Russian banking market would be affected by the blocking of SWIFT, SWIFT, the payment system announced by the West allies. 70% of the Russian banking market would be affected by this, by the new sanctions announced by West allies on Saturday. This is something significant. Its immediate consequence. So what is the immediate consequence of this? The Russian banks will no longer be able to make payments for trade and financial activities. This can effectively prevent Russia from exporting commodities such as crude oil, coal, and natural gas. It would also prevent Russia from importing key technologies such as semiconductors and machinery for its own industries. This is one side of the story. But the new sanctions announced on Russia can hit back the West allies. Hit back. The move will disrupt the flow of oil and gas from Russia to other countries. But EU itself depends on Russia for 40% of its natural gas imports. Also, European banks are among the biggest creditors to Russia. The removal of Russia from SWIFT international payment system will leave a question on how Russian banks will make a repayment on its foreign debt. More specifically, the European banks will not be able to receive the debt repayment due from Russian banks. So this is one way how the sanctions are hitting back on the West allies. Also, the move to block Russian banks from SWIFT would disrupt the global trade. That means that this has global impact, ramifications world over. Although crude oil prices cooled off after touching $105 a barrel on Thursday, because oil went up on Thursday and subsequently came down to $95 by within the next 2 days. But the price reached back to $105 by Sunday, that is February 27, in response to the sweeping new economic sanctions announced by the West allies. So Brent crude oil jumped 7% on Sunday, 7% in a single day on Sunday. So what are the implications of the soaring oil prices? The latest round of sanctions will have significant ripple effects on crude oil markets. The various banking sanctions make it practically impossible for Russia to trade in petroleum. Most banks will not provide basic financing due to the risk of running foul transactions. The move to block Russian banks from SWIFT international payment system will likely to discourage many buyers from purchasing Russian oil. Russia's invasion of Ukraine will fuel sharper increase in the cost of living by driving up energy prices. When energy prices are going up, already high inflation will heat up further. The extra squeeze on household spending is likely to pull back global economic recovery momentum. That means the high oil prices will heat up inflation further, and that will have negative implications on the global economic recovery momentum. If the global economic recovery is impacted, that means we have to expect negative impact on the demand outlook for natural rubber. That means we cannot say that because oil price is going up, synthetic rubber is going to be more expensive. It's good for natural rubber. That is one side of the story. But we have to take into account the slowing global economic recovery momentum is losing steam, and also it is having negative implications on the demand outlook for natural rubber. So now let us see how NR prices performed last week in key Asian futures and physical markets. We have 6 charts. Let us go to chart number 1. Chart number shows the Shanghai rubber futures during the performance of Shanghai rubber futures during last week. So as we expected, Shanghai rubber futures averaged 1.5% lower during last week compared to a week before. That means Shanghai rubber prices were coming down as we expected. This is mainly Shanghai market is too sensitive to geopolitical tension and also various non-rubber factors. Means Shanghai market is by nature it is more sensitive to factors which are not directly related to supply and demand for natural rubber, but various non-rubber factors, especially the prevailing geopolitical situation. Now we'll go to the second slide, chart number 2. This is the Cyclone TSR20 futures last week. So in the Shanghai, we have seen the prices averaging lower, but in the case of Cyclone TSR20 futures, the price averaged 0.9% higher compared to a week before. One characteristics of the Cyclone market is that Cyclone is compared to Shanghai market, Cyclone market is more reflective of the physical market condition. Means psycho market is more sensitive to demand supply fundamental. So this we can see from the chart number 2, which is showing the psycho TSR20 prices. Of course, geopolitical situation had an impact. Still, psycho market average 0.9% higher. Now we go to chart number 3, which is showing the chart number 3. Osaka RSS3 futures averaged 1.3% higher. Osaka market is also more reflective of the supply demand fundamental, although it is impacted by the geopolitical tension. It is a positive sentiment or tight supply outlook had an impact here, and we have to take into account that Japanese yen was gaining last week. When Japanese yen gains, normally the Osaka futures will be coming down, because when the yen is stronger, investors will be less interested in investing in Japanese in the Osaka futures. But in spite of that negative factor, Osaka futures gained last week, averaged 1.3% higher because of the strong fundamental driven by the seasonal low supply. Now we'll go to the physical markets. Chart number 4. Chart number 4 is comparing, is showing the physical prices of FOB prices of STR20 at Bangkok and SMR20 at Kuala Lumpur. STR20 Bangkok average 1.1% higher, and SMR20 Kuala Lumpur average 2.4% higher. Higher means compared to the previous week. Now we go to chart number 5, which is showing the RSS prices in 2 markets. One is RSS3 physical price at FOB Bangkok, and RSS4 local price at Kottayam markets. RSS3 Bangkok averaged 3.6% higher during last week compared to a week before. And RSS4 Kottayam, it was falling down the previous week, but this week it averaged 1.2% higher compared to a week before. In Indian market, tech companies are largely staying away, but they have started buying because now Indian market is gaining because of the global Q, means because of the global uptrend. Indian market also going up. And we have one more slide, chart number 6, which is comparing the latest prices, physical prices of latex at the Bangkok and also at Kuala Lumpur market. At Kuala Lumpur markets, latest prices average 8.6% higher. Means, see, 8.6% higher compared to a week before. In the case of Kuala Lumpur SMR20, as we rightly expected, it was the SMR20, the increase in the case of SMR20 was considerably lower, but in the case of latex, it is the average, it's average 8.6% higher. When we go to the latex market in Bangkok, it's averaged 4.2% higher. So as we expected, latex performed better relative to STR in both the physical markets. Now we will continue. So looking ahead, what lies ahead? Rubber futures, especially the Shanghai rubber futures, are unlikely to gain in the coming week because investors are expected to keep away in view of the risk and uncertainties. Speculative investors, when there is a risk and uncertainties, they will keep away from risky portfolios. Normally, they will be keeping away from risky portfolios, and they'll be rushing towards safe haven. Safe haven, it could be currencies or gold. Safe haven currencies are US dollar, yen, Swiss franc, and gold also is another safe haven. So this is a usual trend. So we are not expecting a gain in the rubber futures, especially in the Shanghai rubber futures in the coming week. But in the case of Saicom and Osaka exchange, need not follow the trend at the Shanghai rubber futures. And second observation and our second expectation for the next week, physical prices can receive the support from the seasonal low supply, because world over the global supply of natural rubber is expected to remain low because of the seasonal wintering of rubber trees, and supply will remain low. But the supply is remaining low, that is one side, but the outlook on demand is expected to come down. So we are expecting some kind of a trimmed demand outlook. Even if the physical market can gain, the supported by seasonal low supply, the gains will be marginal. This is due to the potential negative impact on the demand outlook. As we mentioned earlier, the soaring oil prices and the heating inflation will impact on the purchasing power of the people. The spending will be affected because the household spending will be affected because of higher living costs, and this will have some negative impact on the global economic outlook. And a negative global economic outlook means we can expect some kind of downward revision of the global demand for natural rubber. So coming week we are expecting some kind of a downward revision of the global demand outlook for natural rubber. At the same time, the supply side is positive because of the seasonal low supply. The global supply of natural rubber will be low. So we have low supply, but at the same time, the demand side we are not strong. So this is something we are expecting. That means physical market can gain in the coming week. Even if it is gaining, the gain will be limited. That is our observation. And Saikoma and Osaka exchanges are expected to perform better than Shanghai Futures Exchange. Shanghai is more sensitive to non-fundamental factors, but Saikoma and Osaka futures are likely to reflect the development in the physical market. We are not expecting a fall in the physical market. Physical market is likely to be a little bit neutral or marginally lower or marginally higher. Roughly we can say we are expecting a sideways movement. That's all about the expectation for the next week. We will see again next Monday at the same time. Thank you very much.
Okay, thank you very much, Mr. June Jacob, for sharing your insights on the natural rubber market review. As you may know, I'd like to introduce about one of the program managed and hosted by Mr. June Jacob. It's called NR Dialogue. There is episode number 3. This episode is focusing on the Latin America natural rubber industry. We have invited 3 specialized professionals from Brazil, Latin America. So they will be discussing about the challenges, opportunities in the Latin American NR market. So I do invite all of you to participate in this program on the 24th of March. It's also same time 9:30 p.m. Singapore, 7 p.m. India, but in Brazil time is 10:30.